Hello and welcome to another update video. Today we want to talk about McDonald's Corporation. We start on the weekly chart, and yeah, here you can see that the chart is pretty much in the late stages of a more than, well, several decade long impulse to the upside. It's been a nice impulsive structure, but unfortunately probably entering the very late stages, basically at the top now here of this rally. And you can see that from this, so at least my thesis is that from this 2003 low, which was a significant wave 4, circle wave 4 here, a 5-wave move is basically done or nearly done. We get a few more squiggles to the upside, that's possible, but then we should have, I mean, this long-term top could be in, right? You can see that we've completed 3 waves into the 2019 high. I've got a 2020 low of wave 4 of 5, and I can already count, if I really want to, 5 waves to the upside as an ending diagonal from the 2020 low. So the chart looks pretty toppy, and I cannot rule out another high. Actually, I'm slightly leaning towards one more high, but I have to highlight the risk at this point. I think one more high is possible. It looks better with one more high, considering the microstructure from the 2020 low. So from an Elliott wave point of view, we would consider that a diagonal pattern. And because it is at the end of a long-term cycle, it makes sense to interpret it as an ending diagonal, in which we've seen from that low 2020, a wave 1 to the upside in the white count, a wave 2 to the downside, 3rd wave rally, 4th wave, and then there would be a 5th wave, which cannot be longer than the 3rd. Okay, because I think the 1 is actually longer than the 3rd, so the 5th needs to be shorter. The thing is, until we break support, the trend stays technically intact, yeah? So what we can just double check is the length. Yeah, the the 3rd here is basically shorter than 1. It reached, we can just double check that. In terms of fib levels, yeah, it reached perfectly the 61.8 extension. Normally not a level that I use for a 3rd wave, okay? It is more like one that traditional Elliott wave analysts are using that really, go back to the roots and everything. Yeah, it's that 3rd is quite short, okay? That 3rd is quite short, but I have enough waves in place. So I think that's why I said I'm actually leaning towards one more high. It would look better with one more high. Even if I count the 3rd here or here, I mean, in both of these scenarios, the 3rd is quite short. And I will definitely leave the door open for higher, also especially in the white count, which structurally looks better. One more high would be preferred. That would be wave C of 5, and with possibilities for further extensions until support levels break. I think what I want to communicate here is that as soon as the first support levels start to break, it is at least time to be really on the side of caution, because ending diagonals, when they break and when they finish, then typically they, the trend moves quite quickly into the opposite direction. You can call that an ascending wedge pattern as well. It's the same thing in this case, okay? And these diagonals are characterized by overlapping price structures. So there is one count as highlighted here in yellow where I can actually count it already complete. You see, I have enough waves, 5, and then we would from there start the decline, but that's not predictive as such. I need to see confirmation, I need to see a break of support. I think at the moment the Elliott wave structure highlights the risk and highlights that we're close to a long-term top, but it also allows for one more high, and the trend is up. So from a trend following point of view, it might make sense to follow that idea of one more high at least, as long as the support levels are holding. So which support is that? We're dealing with the orange support region. That's a Fibonacci retracement zone that we know is typically applicable for a B wave pullback. And you can see here this area between 256 and 279. This is quite relevant, and we've already reacted here to the golden ratio level at 265, and a rally could send us higher in wave C, for example, to the 100% extension level of the A wave. It's a very common fib relationship, and that's at $323, possibly further extensions to 340 or even 368. But the condition would be that this last low is holding the May swing low. If we see further downside from here and actually break below 256, that would be the first major warning. I'm talking about a sustained break. And then if we then also see a break below the trend line and the red line would be a good confirmation level, because then we break the first previous swing low. Then I think we are in the downside structure and we are filling in wave C of a larger A wave. We would then look at a larger B wave corrective rally and then another C wave decline to complete that. But that would probably only be due to the larger time frame, the bigger picture, a larger A and a larger B and a larger C. And that will take years anyway, you know. So it would be a substantial downturn. But at the moment, I would still leave the door open for higher. But it's very much important to be aware of these key pivots. Yeah, I hope you liked the update about McDonald's. If you did, please hit the like button, leave a comment and subscribe. And if you are interested in daily updates about the S&P 500 as well as regular updates about stocks, then feel free to check out our stocks and S&P 500 service. You'll find the link in the description. Thanks a lot for watching. Bye-bye.